Okay, let's answer some questions from Sunday's market outlook. And I don't know how many I can get through. I'm doing this on Wednesday at 10:53. Bank of Canada raised 25 basis points. I don't know if you saw that, but I was anticipating that they would. The long Canadian position paying off nicely. Market turning down right now. I don't know how long it turns down for, but here we are. I work in a fund where the investment mandate is similar to an endowment. We are looking at the market with a long-term view, feel there's risk on the dollar in the medium to long term. BRICS countries' total GDP was higher than the G7 last year. Total GDP higher than the G7 or GDP growth? I mean, I would have a hard time to see how the BRICS total GDP was higher than the G7. Forecast to grow much higher over the next 10 years. And there are news articles about them forming their own currency. Recently, Chinese total exports and imports in yuan currency was higher than U.S. for the first time in history. For you as an investor, mostly invest in the U.S. market, how do you analyze the risk that you would position it for the long term? Well, it wouldn't bother me. None of that would affect me at all because all I have to worry about is the relative value of the U.S. to the Canadian. So I have U.S. dollar exposure. I just have to think about it in terms of the Canadian. I don't have to concern myself about the de-dollarization in the BRICS country. I don't have to concern myself with any of that. None of that will affect anything I do. I really just have to think in terms of a relative value between two currencies. That's it. So it doesn't change anything I do because I don't take active positions in global currencies. I hedge out currency risk on the U.S. and every now and then I'll have a small active position, whether it be long the U.S. dollar or short the U.S. dollar versus the Canadian. That's all I'm concerned about. I think you're making history here, at least your viewers' history. Hear about these uncorrelated trades because I've been beta neutral for so long. Uninterested to take any risk in the current conditions. I know something to watch closely, and barbecue season is coming. Yeah. More money is lost in the anticipation of the fall than the fall itself. Yeah, that's probably a good quote. Let's see. I have diligently watched all FRA and equity valuation videos from level 1, level 2, which have equipped me with solid theoretical understanding. However, I'm encountering difficulty in applying this knowledge practically, particularly when it comes to selecting stocks. As an engineer by profession, I'm eager to bridge the gap between theory and practical application in retail trading scenarios. So real trading scenarios. I thought you said retail. In real. Although I've been trading for the past 3 years, it was only after subscribing to the Applied series that I experienced profitability. I'm sincerely grateful for that. Could you kindly advise me on how to acquire practical experience in this field? Well, that comes in just reading 10Ks and 10Qs and really picking a particular industry. You're not going to understand every company's financial statements unless you understand their business model and some of the language of their particular industry and how they make money. And as far as forecasting cash flows and discounting them back, that's an analyst's, an institutional analyst's job. For the retail investor, it's overkill, massive overkill. So if a stock is $100, an institutional analyst needs to have a target price like $123. A retail investor just needs to know it's going up. And that's it. To spend the amount of time, the years to get the experience in a particular industry, the access to be able to interview management and ask management questions, because the statements aren't going to give you everything. You're going to have to go to management and ask questions to get little detail. You're not going to have access like that as a retail investor. You cannot replicate what the institutional side can, and you're not going to have access to the kind of information that they have access to. So it is you know how to do this based on level 1 and level 2. That should make you a good consumer of research, which means you can read somebody else's research report on the auto sector perhaps, or the housing sector, or a particular company, and you should understand what they're doing although you would not be able to replicate what they're doing because you don't have the years of experience they do, you don't have the access to management that they do, and you don't have the access to the types of information that they have huge subscriptions for, that you would have to pay thousands of dollars a year to get. So think about the experience you have from the CFA content, and think about as a retail trader, it makes you better at reading other people's research as opposed to producing your own. Portfolio management question for you. How would you recommend maximizing return when adding positions in small to mid-sized retail accounts? In my case, I prefer the tech sector. And in this example, say I'm looking to accumulate an AMD position. Adding the position via selling puts requires a significant amount of $100,000 portfolio's capital. Then don't do it. It's just that simple. You have to have rules, and you have to operate within rules. So let's just draw a circle here, and let's say that's your portfolio, and you have 100,000. Your first decision is your allocation. Is it 100% in equities? Or are you going to divide your portfolio? So let's say that you say 60% will be equities, so 60,000 is equities, and you might say 20,000 will be for fixed income securities because you have a nice high yield. So there is good potential for capital gain if those yields come down. And here you might say, well, let's go with commodities. There's a nice allocation. For the 60K, if you just want access to the market, you can put it all in an ETF. And this means you are large cap. And this is a mix between growth and value. If you say, well, I want some small cap in there as well, you can say, well, I'll put 40,000 in SPY and I'll put 20,000 in IWM, which is the Russell 2000. So you have a division in there. And then you can slowly say, well, okay, instead of 40,000 in SPY, there's only 3 sectors that I really want. So let's put 13,300 in the XLY, maybe the XLT, and maybe XLC. And you say those are the 3 sectors I want to be on if you're interested in tech. Or you may say, well, why do it this way? Why not do 20K in SPY, 20K in IWM, and 20K in QQQ? So there's your tech. There's lots of ways to divide it like that, such that you have good exposure. Now, you may say 20,000 in one position. Well, no, it's 20,000 in 500 stocks. This is 20,000 in 100 stocks. So you're getting a lot of diversification out of that, right? But to just sell puts on one position that would end up being 40 or 50% of your portfolio is not wise at all. I want you to think about your portfolio as a portfolio, not a portfolio of assets with a return, but a portfolio of risk, because you are taking on the risk of certain assets. And when you take on risk, you can either get hurt or be rewarded. We get paid for taking on risk, right? Manage risk. Return will take care of itself. And you manage risk by thinking very carefully about your allocation, thinking about your level of diversification. And then once you have that in, you have to also think about, well, how will I manage the level of risk that I have now? What are my rebalancing ranges? A whole bunch of that to think about. If you have the applied series, starting August 15th and running, I think, for a number of weeks, for almost, I think it's 5-6 months, weekly, there'll be a video on this, all about managing a portfolio of risk. And the first thing on week 1 we're going to do is we're going to set up all our screens. What currencies are we going to watch? What commodities? What fixed income? What ETFs are we going to watch? What futures are we going to watch? So we know what it is that we're looking at. And then we're going to go into the week after, we'll talk about our strategic asset allocation and rules. You have to have rules. And a rule that you will develop is no one position should hurt you. No one position, no one single name stock should be able to take you down. So diversification is the big thing. That a lot of risk management comes up front. And then each week we'll add more and more complexity. As you grew in your professional career, changing jobs at different points, I never had a job, really. What did your personal net worth growth look like over time? It looked like any stock chart of any small cap stock. There were when you're in university, you're just drawing down funds, and then there are periods. Oh, things are great. No, things just got bad. Oh, things are better. Things are better. Well, that really sucked, and then whoa, I really hit. It looks like any small cap stock. So that when you think, well, when I was 20 versus when I'm here, look at this. Well, that doesn't happen every year. Those geometric returns don't happen. You have a couple of years where things are good, and then suddenly things turn bad. Then things are good, then things are bad. That is, I think, everybody's story. It's I think a rare event where you can just simply continually compound your growth year after year after year. Now, if I had to go back, knowing what I know now, go back and give myself some advice, the biggest advice I would give myself, the biggest advice, number one, is risk. Always be aware of the risks that you're taking on. Now, you do have to take on risk. I was an entrepreneur. I started my own business. Well, that's a big risk. Pay attention to risk. Reward will show up on its own. Manage risk. Consistently manage risk in your life. The rewards will take care of themselves. So, just think about it in terms of health. Maintain a good weight. Manage the risk of heart disease. Manage the risk of diabetes, because these things are really endemic in the U.S. I think diabetes is off the charts in the U.S. So you watch your sugar intake. You watch the type of foods you eat. You exercise. You keep a healthy heart. You're managing that risk. And you know what? The reward takes care of itself. A long, healthy life. So your goal is not a long, healthy life. Your goal is to manage the risk, manage the downside. And if you do that, the upside takes care of itself. I think that's what I would go back and advise myself is pay attention to the left tail, always the left tail. That's what you want to avoid. The right tail will happen on its own. It's the left tail that will take you down. And when we talk about outcomes, there are no deterministic outcomes. All outcomes are a distribution. All outcomes are a distribution. Even in stocks, you have some expected return. And that expected return is either some arithmetic mean or some geometric mean. But you have dispersion, right? That if you could just say, well, I'm going to manage my risk such that this doesn't happen, you improve your compounded returns over time because you're taking out the left tail. That would be the big advice I would give. Let's see, regarding TLT, IVP being at 0%, I've noticed this happening to a lot of my June 16th positions, so I've been closing them out decent profit and hope to open new positions when price pulls back or IVP raises. Everybody's waiting for that to happen. There is no volatility. There's no money in the premiums anymore. I'd like to roll my puts forward, but the premiums haven't seemed worth it. I agree with you. Do you think this strategy makes sense, or am I missing something by not rolling continuously and being in the trade? Yeah, even if you're rolling at a constant delta, not just a constant strike price. So it's not as if you're rolling a 50 strike into the next month's 50 strike. You're rolling into a 30 delta, which means you may be rolling your puts every time you roll. You're rolling up if the stock price keeps moving up. You just keep rolling at a constant 30. As implied volatility drops, those 30 delta puts become cheaper and cheaper, which means when you're selling them, you're getting less and less for the same amount of capital that you're putting out. That is the issue with implied volatility is when it drops, there's not a lot of money in the premiums. So you'd have to, you got to think about, well, what do you want to get done? The first thing is, what do you think the underlying direction of either, if it's a stock, what's the underlying direction of the stock? And if you think it's up, then you got to get more aggressive with the puts and maybe go to a 50 delta, or even an in the money put like a 60 delta, thinking the stock price will rise above that price over the next 30 or 60 days anyways. As volatility drops, would you ever consider long SPY puts for mid next year? Not really, because I am at heart a factual person and very concerned with valuations. And right now I'll draw a line and I'm on this side over here, valuation. And I cannot justify the valuation. I must leave that behind and head to the other side where I'm more behavioral and psychological, because that's where we are in the market. And a behavioral and psychological market cares little about valuation. It is not, I shouldn't say it's not that they care little about evaluation, they are agnostic to valuation. And for the type of markets we have where they see momentum driven, 7 big stocks driving the market, the big narrative is AI, the second big narrative is the Fed is on pause, the third one is the Fed's going to cut by the end of the year. I'm sure you keep hearing that still showing up. There are still some people who believe that the Fed's just going to cut without anything being wrong and everything's just going to work out wonderfully. They're agnostic to valuation. So their thinking is, if I do not buy the market at 4,300, I cannot possibly sell it at 4,350. So to sell it at 4,350, I have to buy it at 4,300. It's difficult to work in a market when you're focused and anchored on rational analysis and valuation when the market is more behavioral and psychological right now. And because I'm anchored over here, I find it hard to say I'm going to buy puts for next year, because I would then have to become very behavioral and psychological. And I'm just not there. I'm thinking that if SPX pumps to 4,500, buying a deep out of the money put, I might offer some cheap insurance. Well, yeah, it would offer some cheap insurance. I still believe the path to the rough landing goes through green-looking pastures. How long can an economy survive on hot air? If we go back to the late 90s, it was 17 months. Late 98, I call it November 98. 99, NASDAQ was up almost 100%, and it continued on till about March of 2000. And it did this, I'm not kidding you, and every day it was, you're looking at markets every day here going up 10, 15 points, and Tesla and Nvidia and Netflix adding $6-7 a day every single day without any incrementally new information, and it just keeps going up. Now do that for 17 months straight. Think about how, when you look at these prices going up, saying this is ridiculous. Imagine that going on for 17 months straight. That's how ridiculous it was. I can remember 99 is almost everybody agreed that this is ridiculous. These companies have no revenues. They're just eyeballs. None of this is going to pan out. This is going to end badly. But everybody felt that they were the only ones who thought that. And everyone felt that everyone else is irrational. And everyone thought that. This person over here said, all these people are irrational. This person over here said, all these people are irrational. This person over here said, all these people are irrational. The most rational thing for me to do is to be irrational. And that's how you get bubbles. Because everyone in a bubble knows it's irrational, but the rational thing to do is to be irrational, and you get that kind of outcome. With AI and everybody talking about AI, that is a tough narrative to beat. I've seen this before, just the promise of everything. So, and the promise that it is a significant technology that can change things. And I believe it is, much like when the internet showed up, I believed that it was fundamentally changing or a catalyst for fundamental change. But it was not worth what some of those companies were worth. And it's going to be the same thing now, but we've only been irrational and exuberant about AI for 3 weeks. If it's anything like the .com era, 17 months. We've still got 16.25 months to go before somebody says, this is not working out, is it? And not only that, analysts are coming along as well. Price target on Netflix today raised to 500. Price target on Apple today raised to 220. Price target on I think the 220, and market cap of 3.5 to 4 trillion. Market cap on Tesla was raised. Market cap on price target on Netflix was raised. Nvidia, price target of 500 now on Nvidia. So like the analysts are all coming out raising their price targets on these 7 stocks, and right now the market is 7 stocks that are under momentum with AI, that are trading behaviorally and psychologically. You can't stand in front of that. You can't buy it based on its valuation, but you can't short it based on its euphoria. It's a tough place to be. Okay, next paragraph here. A forward-looking perspective is that short ES trade is too risky right now, and you're aggressively managing it. Could that not be an argument that the margin used there could be better used? Volatility is plunging, and there's less and less an option premium to use effectively. I'm in a similar but slightly worse position, and I'm questioning just moving on because even the upside of the trade seems to be in question. And the downside looks almost inevitable given classic American risk-seeking behavior. Yeah, I've made this point before. It's not that I'm not really looking at the fact that the options have low premium right now, which they do. It's that these are options on futures, and the futures have carry, and the options add more carry because the futures price is well above the SPX. SPX is the index price. So if you look at where the futures price is for the September contract, and you look at where SPX is, even if SPX goes up 60 points, if the futures contract goes sideways, if SPX goes up 60 points by expiration, you don't lose anything on ES by being short because it was already well above where SPX is. So if SPX is, let's say, 4,300, and the Septembers are, I think, 4,380. I think they're around 4,380. There's about 80 points in there, and you sell a 4,380 September call for 100. You're at 4,480. SPX would have to get all the way to 4,480 before you, by expiration, before you lose money. So there's plenty of carry in there, even though the premiums don't have a lot. The premiums are centered around the forward price or the futures price, not around the index price. So you have 2 forms of carry in there. So that adds some value. And I've demonstrated in the applied series that going from negative $4,000 to zero is the same thing as going from $0 to $4,000, and sometimes easier. So if you're sitting on a loss of $4,000 and you work your way to zero, some people say, why not just abandon the loss and go on to something else? Okay, well, abandon the loss. You start at zero, you got to make it up to $4,000. It's just as much work. It's just as much work going from 0 to 4,000 as negative 4,000 to 0. So being that I have a lot of carry that I can use to my advantage, I'll continue holding that position. Are you interested in translating the information into AI automated analysis? Not really. Do you think the CES net birth death model could be affecting the establishment survey data? It seems to me that the model's underlying assumption that the net between new business births and deaths is relatively stable should be tested in uncertain economic environments. When we say that something is stable, it's stable over the long run. It's not stable month to month. When something is stable, it's what's called mean reverting. Is that when it gets too far away from a certain level, it will return to that level over time. I wonder if that new employment figure get revised downwards. It seems impossible to have such a jump in unemployment with such an upward surprise on jobs. I suspect the tension between the household and the establishment surveys involves quite a bit of error this time. Yeah, it is. The establishment survey seemed pretty good. The household survey seemed pretty bad. Yeah, I think until we move past, well past the disruption that we had, I think there is some problem with the adjustments that they're making. But which one do you believe? Which one do we use, right? Would it be possible to add structured products module to applied series? I can, except there are some brokers who will not allow you to trade structured products, and then some like IB which will, but you must ask for permission to trade a structured product. I don't know that given the riskiness in structured products and the embedded risk in structured products, if it's necessary to add it. Just because it exists doesn't mean it needs to be traded, right? Current expectation on rate hike 25%. Given that Treasury will be selling tons of bonds in the next month, is there support for the argument the Fed will pause on this one to not give away free basis points? And then go back to hiking. I don't know. You had Australia on Tuesday go 25 basis points, and they pointed specifically to wage inflation, of which they point out that the Labour government is the one actually causing the very inflation that they have to continue to raise rates against. So government and central bank in Australia seem to be openly fighting each other. Canada went 25 basis points today, and it didn't surprise me at all because wage inflation, the last number for wage inflation we saw came in 2 times the estimate. And the last CPI report Canada had showed every category increasing. Well, you have the same thing in the U.S. That the idea that the Fed is going to be on pause next week, I think, is premature. If anything, I'd call it a coin toss. I wouldn't say it's 25% probability of a rate hike, 75% probability of not. I'd say I think we're closer to a coin toss than anything. And I don't think that they're going to be too concerned with what the Treasury is doing. Let's see, a question regarding option pricing. The at-the-money strikes usually carry the highest premium. No. The highest at-the-money strikes usually carry the highest time value. Not the highest premium, the highest time value. Just to give you an idea, let's say that you have a stock that's currently at $50, and you can look at a $60 call or a $40 call. Well, a $40 call is going to be worth at least $10 plus time value, whereas the 60 is just time value, right? And then at the money has no intrinsic value whatsoever. It is all just time value. It will have the highest time value, and then as you go higher, time value drops off. And as you go lower, time value drops off, intrinsic value increases, and there's just no intrinsic value here. So an at-the-money option has the highest time value, not the highest premium. However, the further out of the money you go, implied volatility tends to be higher than at the money. On indexes, skew tends to look like this. So here's at the money. This is implied volatility, so the deeper you go, the higher the implied volatility. For calls, it will tend to drop for a bit. If it's stock, it tends to look like this, so that the higher you go this way, the higher the implied volatility. But that's implied volatility. That has nothing, well, I shouldn't say it has nothing to do, but it's not that if you have higher implied volatility, you'll have higher premium. Keep in mind that even though the calls have higher implied volatility here, they are further and further away from where the underlying stock is. So there's still the delta component of, look, there's very low probability it will get there. But it'll be priced, and maybe you'll have an option where you look at the bid ask and it'll be 0.05, 5 cents to 10 cents, when it really should be 0. Right? The model would tell you, BSM would say, well, it should be 0, but it's 5 to 10 cents. So being that it's 5 to 10 cents, implied volatility must be making up the difference, and that's why it's as high as it is. Let's see. I'm confused. Does this mean that while in absolute terms the premium might be higher, the time value higher, the premium per delta, the time value per delta ratio, I don't know why you're doing a time value per delta ratio. I'm not sure why you would be comparing those two. The time value per delta. No, because the further out of the money you go, yes, the deltas change, but I think you would be looking at the invested capital that you're putting up as a ratio. But IV to delta. I don't know that I would do that. I don't know what information you're getting there. Is there an alternative with no distribution and with liquidish options to play the long duration positioning? Well, fixed income has distribution, so any vehicle that tries to emulate that is going to have distributions unless you go right to derivatives on, well, I shouldn't say derivative, go to futures. So you can do ZB, which is the bond futures, and you can sell puts on ZB or buy calls on ZB. But ZB gets very illiquid if you go more than, like you have the front month contract, so June, you have the next month, September, and then there's a December. You're not going to get much liquidity on this one at all. You're going to have the best liquidity here. Liquidity in September is improving because we're getting close to the June expiration, but there's no liquidity here. TLT doesn't expire, right? I mean, the underlying, if you get the underlying, it does not expire. A way to avoid that, if you want, is rather than to hold TLT, create a synthetic. And then you have no distributions. All the distributions will be within the puts. Let's see, a paper. You mentioned a paper trading portfolio for the accounts to manage alongside your weekly as part of the Applied series launching August 23. Yes, it is. That will launch August 15th, 2023. So we are, where are we? June 7th. So we're about 9 weeks away from launching that. What do you think about the oil market for the rest of the year after Saudi announced a further cut? The market seemed to sell it. They didn't seem to rally with it. They seemed to sell it. And I've heard analysts saying that oil price will likely reach 85 to 100. Not Citi. Citi says it's unlikely that they'll reach 85 to 90 bucks. They don't see that as likely at all. Could you explain how the time value components from puts and calls change? Okay, I already did that. Look into our 7% deficit and how it plays a role in supporting the economy with $2 trillion of extra spending created. Oh, okay, well, you're just supporting what I said in the video. Saw an article in Barton's today that discussed the risks present in shadow banking. Do you think this poses a bigger risk to the economy versus the tighter lending standards currently being imposed by traditional banks? Yeah, a lot has been said about the fact that, listen, if banks fail in their job, there's always the private credit market in behind that's willing to lend at some price. And in 2008, 2009, they did exactly that and did very well. So I don't know that I would say there's risks hanging out there because those are all private funds with accredited investors. I don't know that the Fed would rush to bail out a bunch of accredited investors. So, and being that I didn't read the same article as you and see what risks they were pointing out, I'm sort of left to guess what risks they're trying to assume. So I guess the easiest answer to that is I without knowing what you read, I don't know that I can address that question. AI hype is everywhere. Yep. So does some illegal activities due to lack of regulation? What kind of regulation rules do you think would be suitable for AI? Well, what rules or regulations would you put in place for criminals? We have one that says it's illegal to murder people, but people get murdered. So, you have a law with a big punishment that if you murder someone, you'll go to jail, and people still get murdered. So even if you have rules and regulations in place, that's not going to stop criminals from doing what criminals want to do. I don't know what you would put in place. Are criminal organizations going to use AI? I'm sure they will. Criminal organizations, I think, are responsible for blockchain. I don't think that paper was written by an individual. I think it was written by a criminal organization or a criminally based country, but it had to look like it came from something else. Otherwise, it would never be accepted, because I don't know that you could design a better system for criminals than a blockchain and crypto. I don't know that you can get a better system for criminals. So will criminals use AI? Will bad actors use AI? Will states And governments use AI? Yeah, they will. Do you think the US will use AI to develop some kind of weapon? Of course they will. Of course they will. While they wag their finger at other places saying, oh, you're going to use AI to do this. And even if there's regulation, you really think the Pentagon is going to abide by the regulation? There'll be no dark ops going on. There'll be nothing going on at Area 51. So yeah, regulate it all you want. I don't know how you're actually going to get that done, to regulate something. I don't know how you're going to get that done, but criminals will be criminals. I had a small short position in triple Q that is a bit in the red. Yeah, I would not short that. I played it tactical, as you like to say, and I'm comfortable with the small loss that is now. However, I'm extremely hesitant to increase. Yeah, do not increase the short position due to the absurd sentiment surrounding tech and AI. Yep, that's exactly it. I've been considering just going long TLT with short at the money puts for a while instead of doubling down on short QQQ. What do you consider the biggest risk to simply going long TLT as a recession play instead? Well, that the recession doesn't show up. And that inflation is sticky, and that interest rates at 5.25 in 6 months will look like wishful thinking when we're at 7%. I mean, those are the big risks. The big risks is that we keep going higher. The big risks is that the market continues to be resilient because, 80% of the market really is immune from interest rates. 85% of the market right now is immune from interest rates. So to get to where they want to go, I don't think 5.25 is enough. I think you got to add 300-400 basis. I think you got to get to 8 or 9% to get to 60 to 50 to 60% of the market feeling the rate hikes, because most people are immune to it. I'm immune to it. I have no mortgage. I have no debt. I have investments, so the higher interest rates on fixed income are only benefiting me. So you have a segment of the population, 10 to 20% of the population, that is benefiting from higher rates. You have retirees, anybody on pensions, that are benefiting from higher rates. Pension funds are benefiting from higher rates. Homeowners with fixed rate mortgages are not feeling anything, and as long as they're later in life, the households who are 45 to 50 who have net wealth and very little debt, no car loans, no credit card loans, they're not feeling any of this right now, and their wage gains are keeping pace with inflation. Again, 5-6% wage gains per year. If anything, the interest rate hikes really are not working the way they would, let's say, 20-30 years ago. So the biggest risk to TLT is that central banks start saying, this shit's not working, we got to go higher. Maybe theory says 20 years ago that 5.25, 5.5 would have done it, but given the resilience and the protection that the world has in place right now, most corporations that have debt have interest rate swaps in there. They're not feeling anything. So the Fed may actually have to go much further than what we think. There's the risk to TLT. And if only 15 or 20% of the economy is feeling rate hikes, that's not enough to tip it into recession. There's your big risk there. While the Fed may or may not be finished with the rate hikes, I don't think they are. In my view, the majority of hikes are behind us. Okay. Looking to primarily get your opinion on the risks of how this trade could go bad. Well, it could go bad because the recession doesn't happen, in which case the safer way to do it is to go out to March 2024 and buy the 105 calls. They're sitting at around $5 right now. The most you can lose is $5. That's the most you can lose if you want limited downside, and you'll get negative convexity. Positive convexity on that, because as the market goes down, the calls will drop in value at a slower and slower rate. So your losses end up slowing down. But since it has positive convexity, your gains would end up accelerating on the way up. I'm short the market. This position is bleeding out thanks to this nonsense market. Yep. Nvidia changed everything. Everything looked like it was in play for a weak market until Nvidia said, hey, AI. And then Bloomberg jumped on board and had a whole Friday of nothing but AI. AI. I'm thinking on selling puts with higher strike price to artfully set my loss. Nope, 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 nope. Oh, selling puts. You're short the market, you want to sell puts. That will do it, yeah. If the market keeps going up, they won't get put to me and I'll keep the premium. Yep. What other tactics can I use to hedge my never-ending losses? At what point should I consider taking a loss? Well, rebalance down. Sell some puts. That'll help you out. You can also roll forward from June to September and pick up, I think, for almost 50 points a carry. So you add another 50 points that the market would have to go up by just to catch up to where your futures price is. So you can roll forward to September and sell puts at the same time and add a bunch of carry. But this market can keep going up, ban up, ban up, ban up, ban up. And when you think it can't go up anymore, it'll go up. Then you hear people saying, this market hasn't begun to go up. We think it rips higher from here. And they'll use the word rip higher from here. And it's like, anyways. Recently started doing the income factory strategy and it's been going well. One thing I've noticed this week is that the energy sector looks like it may generally be great for this strategy. And it has been. The XLE, I think, went from 76 to over 80 bucks. As it is quite high IV. Yeah, many stocks look like they trade in ranges, especially Oxy. I think since, if I look at my income from the beginning of the year, I think the underlying that I made the most money on has been Oxy. The most money on. What do you think of using this sector for this strategy? Yeah, I think that's the energy sector I think is good. Also with the income factory, you've mentioned having basically a stop loss rule of cutting a position at a certain point. However, I've been doing this past few weeks. I've been working the strategy would have been far less profitable. Yeah, you know, it depends on what's going on with the underlying. There, you know, if you're generating income, what most traders who are generating income like to do is to be delta neutral. So they don't just sell puts, but they'll sell a put and they'll sell a call. Well, that's kind of dangerous, especially the call side. Not the put side, because you can always own the underlying, but being short the call side can be dangerous. And that's why they will usually just take their profits at 50%. Because if you're selling a call and a put, let's say you're getting a buck on either side, which means you have $2. And if you take your profit at $1, that's the same as selling the put and waiting to expiration, right? But the short put is not as dangerous as the long put. There's a long call, so you're short the call, you're short the put, and you got a buck on each one. So you're, if you think about the distribution of returns, right, you are selling the tails and hoping that the distribution stays in the middle. And by doing that, they're as delta neutral as they possibly can. And they try to get to, you know, the whole portfolio to be neutral, so that no matter which direction the market goes, they're not going to get hurt. They're just going to earn theta. But you have to watch your underlying positions, and you're looking to get half that income, half that premium as income, and move on, because it's this that's the more dangerous one. Let's see. So I think I've answered that. On a separate note, could you please do an energy sector video in the applied series? That would be wonderful. It seems to be a great sector to trade. Yeah, as soon as I get back to it. On changes in expectations for the next FOMC decision, I saw the probabilities really change after Jefferson Harker speeches. They openly advocated for a pause. Yeah, I think going into this next meeting, you're going to have, you know, I think a third of them have said that they see further increases. A third of them have called this meeting a skip, and a third of them are already saying, I think we're here. So it'll be interesting to see what will happen, given that Australia and Canada both increased this week, and that the data in the US fell along the lines of what both Australia and Canada have been seeing. Is there a way for retail traders to be involved in CDS at all? Only if you can find an ETF that packages CDSs. But CDS is OTC, over the counter, which means you need a dealer, and a dealer probably would not consider you a viable counterparty. Would not want to take the credit risk of you as a counterparty. If TLTs are put back to you with higher duration, A TLT is an ETF with a managed duration, so it wouldn't have a higher duration. There is a managed duration. It's an ETF. Wouldn't that be a net negative? Nope, nope, nope. Having shorter duration would be more beneficial. Well, shorter duration has no benefit or very little benefit for changes in rates in terms of the capital gain that you could make. It only has exposure, or at least primarily exposure, to changes in rates based on a floating rate, hopefully a floating rate that you would get. But since it has low duration, you're really at that point earning the yield to maturity if you hold it to maturity, if you hold it for that period of time. If you are thinking about capital gain when rates are high, you want to buy long or high duration bonds, which are usually long dated bonds. But it's sometimes difficult to get done. The easier way to get it done is within a portfolio already, and TLT does that. But TLT has a managed duration, so no, it wouldn't bother me. Dig further into the discrepancy between household survey and establishment survey. How come one show we added 339, the other show we lost 440? Well, no, we didn't lose 440. The unemployed amount went up by 440. We lost 310, but 130. The population grew by 130. The estimate is the population grew. The working age population grew by 130. Difference of 779. One of them has to be wrong. Well, alternative is they're both wrong. That maybe it was 0 jobs that were added, and they're both wrong. Hard to go into the discrepancy between the two other than to say that there are discrepancies between them. It's quite common to have discrepancies between them, and then as you get better information, they are restated. Long-term demand side of the housing sector is a big question mark for me. Historical population growth of the U.S. over the past 50 years is 1 to 1.5% per year. CBO projects the future population will be 0.5. U.S. has already added more deaths than births and will only grow due to net immigration. Or, well, we don't say net immigration. Immigration is in, right? So net migration. So we would take out the IM. It's net migration. So that's immigration and emigration. So we wouldn't say net immigration. You get what I'm saying. Most of the immigrants it lets in can only perform low-skilled labor. That's not true. That's not true. The tech companies sponsor a lot of visas to bring people in, so that's not necessarily true. Most of the people showing up at the border claiming asylum tend to be low-skilled individuals because they really have no choice. But if you are a PhD or a master's holder, especially in the STEM fields, you probably can get a job in the U.S. with a company that will sponsor you on a visa. So it's not true that most of the immigration is low-skilled labor. It is probably more true that most of the immigration that you see at the border coming across seeking asylum is low-skilled because PhDs aren't crossing the border that way. You got a PhD in physics or mathematics or computer science, you're not crossing the border that way, right? So that is, what you're seeing there. Won't be able to afford expensive homes. Isn't this bearish for housing prices in the long term? Well, not really, because they got to live somewhere. They got to live somewhere. So if they squeeze out people out of apartments, then those people will have to go somewhere. But they have to go somewhere. So the more people you have, the more homes you need. And if you've been in Toronto and driven through places like Vaughan or Brampton, it is not uncommon to see 7 or 8 cars parked outside of every house. And that there are 8, 10, 12 people, sometimes higher than that, living in every house. So that you have how many people sharing the cost of that household now, right? Can you share your thoughts on demographic trends and how they will impact the real estate market? The U.S., I think, is more anti-immigrant than Canada. Canada is very pro-immigrant. Canada is going to have a very difficult time with housing. Housing is going to become extremely unaffordable based on what the government currently has set as its immigration levels and the absolute regulation that it imposes on housing. Hey, we want to let all these people in, but you can't build houses there. It's like, do you not see the contradiction in these two things? Like, what are you asking people to do? You know, we want affordable housing, but you can't build houses, and we're going to let a lot of people in. Can you not see how you can't have all three of those at the same time? You know, and, well, we're dealing with politicians, so my answer to that is no, they can't see that. They can't see. They think they're doing the right thing, and they're making decisions. But they're all making independent decisions without realizing that those decisions have to be made as a portfolio. As the U.S., as far as the U.S., there's still a structural housing shortage in the U.S., and they still do have net migration in. So you still need housing. Would you say that you're synthetic long on the position? You mean the forced put or the? When you say that you're synthetic long on the position, you mean the forced put or the synthetic long? A synthetic long means that I'm long synthetically. It means I don't really own the underlying, but I have the same exposure as the underlying. So put call parity equals this plus PVX, which is the present value of the strike price. So to be long synthetically, I need the stock to equal something, and it's C minus P plus PVX, which is just the present value of the strike price, which means I'm long the call, short the put. There's a way to create a synthetic long position. I don't know what the forced put means, though. How do you decide that you'd rather be synthetic long than long on the position? When I don't want currency exposure. Simple as that. I'm in Canada, and I don't want to convert Canadian dollars to US dollars to then hold in a position. If I take a synthetic position, it costs me nothing. If I can work it out, so if it's at the money, it should cost me nothing. I'll need margin, but I can satisfy that margin with Canadian dollars, and I avoid currency exposure. The only exposure I have is the gain or loss that happens at that time. I'm asking because I'd like to be long some US ETFs, but my country does not allow me to trade ETFs directly. I can buy them via option and hope that they will be put to me. Well, they can't be put to you. If you can't buy them directly, I'm assuming you can't own them, US ETFs, then you can't have them put to you. I wonder if there's even an advantage of doing the forced put and then being long versus just being synthetic long. I know we get the time value advantage in the case of the forced put. Okay, so I don't know enough about your position to understand this, that your country doesn't allow you to trade the ETF, but somehow you can be long the ETF if you get it through a backdoor option like selling a put. If I have that right. And now taxes, I can't answer that question either because every country is different on taxes, so I'll move on. Could the inverted yield curve and the current tight spread in OAS just mean the fixed market expect the inflation to melt away without any recession? Yeah, well, it could mean that. It is consistent with that, but the data is saying no, that is actually not going to happen. I don't think that the tight spreads on OAS would be a result of that. I think the spreads on OAS reflect more the cash levels that corporations have right now. Do you have a maximum DDB percentage target? Nope. Also, if we are looking to go lower our DDB percentage against short calls, you mean raise your DDB because you're short the call. I know your short puts are a good option, but VIX being historically low, I hesitate to pull the trigger. I know you were long other positions, but wanted to see what your thoughts were on buying SPY calls 30 to 40 days out instead of selling puts. Yeah, you can, but buying calls has negative carry, right? You you're going to lose theta every day. And for it to make money, the market has to go up by more than the price of the call over those 30 to 45 days. But yeah, that is one way you want to add delta. Buying calls adds delta. Can you please explain the mechanism of how issuance of Treasury securities will suck out the liquidity repo facilities? Well, I have money. I'm a money market fund, and I have nowhere to put it, so I put it in a reverse repo facility. But if there were more T-bills available, I'd buy those instead. That's it. That's it. Some people argue the government issuing short-term Treasury will continue to suck liquidity out, but some think it will inject more liquidity in the system. Well, yeah, it could bring more liquidity into the system because if there was nothing there to buy, well, how can you put liquidity into a market where there's nothing there to buy? Or there's very little to buy. In fact, the less and less there is to buy, the less and less liquidity there would be because money would just go somewhere else. So if you have greater supply, you probably would have greater demand and thereby increasing liquidity. Could you briefly tell me what drawing tablet you use to create all your slides? I use a Cintiq 13D along with Sketchbook. With volatility on SPY at such low levels, would you consider long-dated straddle? So you have to look, if you're thinking about long-dated straddles, look at the term structure of volatility. This is volatility across all the future months at the same strike price, and it typically looks like this, right? So with current volatility this low, you're going to have a curve that is in contango, which means you go to long-dated options, you are probably going to have a higher implied volatility at some future point in time. So you are paying for it in those premiums. Not only that, even if short-term volatility spiked and went up, the curve would still tend to look like this. So you wouldn't get the big move up in volatility that you get at the front of the curve. You get a little bit, the further you are on the flat part of the curve, the less it responds to changes that happen in the near term. Everything that seems to have a benefit has a disadvantage, right? There's nothing with nothing but benefits. I've never been more confused about why a market is doing what it's doing. You and me both. All I've been doing around a long time, spinning all data as positive or flat out ignoring it. Whatever happened to don't fight the Fed and higher rates are bad for high growth and tech stocks. That is true. The narratives they blew up our collective 20. Okay, I'm having a hard time reading this. What changed? Rates are at 3-decade highs, and the Fed has reiterated they will stay higher for longer. So let me give you an example of something here. Let's say that I have I'm trying to come up with a good analogy here. A good analogy is this. Let's say I spend $100,000 a year. I have no debt. I don't use debt at all. And the Fed the Bank of Canada is trying to lower aggregate demand, so they raise interest rates. What's that going to do to me? Nothing. It has zero effect on me. Zero effect altogether. Now let's say I'm a corporation and I do have debt that I got at a low rate, and I have an interest rate swap in place, which is a receive floating pay fixed swap, and my debt is floating rate. Right, so I'm going to pay a fixed rate, and the Fed starts raising rates. Well, I start receiving more and more on my swap to pay more and more on my debt, and I still just pay a fixed rate. Raise rates all you want, doesn't affect me. Well, you have the financial market has gotten so sophisticated over the last 20 years that you have more interest rate swaps being used, more CFOs that are much more sophisticated in the use of derivatives, a lot more corporations that are genuinely immune for the most part to interest rate hikes. Not completely, but for the most part immune to interest rate hikes. Plus you have a lot of corporations that have cash and cash equivalents. Look at Apple. What has they got? About 130 billion. Well, that's not sitting in cash. It's in cash equivalents, which is 30, 60, 90-day T-bills, all earning 5%. So as far as higher interest rates, you're actually helping some corporations that, when you think about their debt, you have to look at their net debt, which means you take all the cash they have and you offset it against the debt. So sometimes companies have debt, but when you consider their net debt, they actually have no debt, and they have interest rate swaps in place, so they're doing nothing but making money with higher interest rates. So if 80% of the economy is immune to your interest rate hikes, well, what can you do? I mean, this is the whole idea. If you're a level 3 candidate, you're going to see the word immunization. This is the whole idea behind immunization, is you try to use derivatives or assets to immunize yourself against changes in interest rates. Well, that is a big thing being done in corporations and in a lot of different places, other than just households. But in the U.S., what is it, 80% of homeowners right now have 30-year fixed rate mortgages. So your interest rate hikes are really affecting a small group of people. Yeah, interest rates are at a 3-decade high. However, what's different today that you didn't have 3 decades ago is the sophistication of immunization strategies, such that these interest rate hikes really aren't doing what they used to do. So, yeah. And I think another thing that you have today that you didn't have 3 decades ago is the wealth transfer from one generation to the next. You have the baby boomer generation that is entering retirement, and sometimes some of them are now, 75 years old, 80 years old. They're passing on and leaving large amounts of wealth to the next generation that then can buy homes with cash. What is it? Something like 24% of all homes in the U.S. are bought cash. No financing associated with it, or just paid for cash. So the cash buyer is immune from higher interest rates. Most of the market right now, I'd say, is immune from higher interest rates. So when we say the interest rates work with long and variable lags, yes, they do. That if we think that only 20% of the economy has felt the full 525 basis points, we've raised it 500 basis points. If only 80% has felt the 20% has felt the 500 basis points, you can weight it, right? 0.2 at 500 plus 0.8 has felt nothing. So the market has really only felt maybe 100 basis points of hiking, which means there's 400 still to be felt. So if you want to destroy demand, you either wait for these lags to kick into place, or you bring these much, much higher. So instead of 20%, it's now affecting 25%. Now it's affecting 30%. But you're going to have to do something because the long part of that lag could be quite long, considering the sophistication of immunization strategies today. How did you calculate the basis points that have not been priced in yet? Well, if you look at a rate today, the effective federal funds rate is 5.08. Go back 6 months and look at what the effective federal funds rate was. What was it, 383 6 months ago? So 508 minus 383. What is that, 125 basis points? If you think everything works with a 6-month lag. How much change in the mix of employment can actually impact AHE? Plus minus 100 to 400 doesn't seem to be a significant number compared to the total number of employees. That's true. If mix is not really that important, then AHE will be a relevant wage inflation indicator. But mix is important. The mix of jobs in an economy is important. So when we look at the number of part-time jobs are quoted in what are called full-time equivalencies. When you look at the number of that gets paid less than full-time. Younger aged workers get paid less on average than higher waged workers. So there is information in the mix that can't be ignored. AHE is a messy number. If you relied on AHE in January, February, and March, it did not prepare you for the ECI, which is the Employment Cost Index, which does measure the cost, the wage inflation in a job, because it doesn't measure the individual in the job. Now keep in mind, what we're seeing is a net, and this might be worth exploring just a little bit here. When you see a jobs report come out and it says we added 339,000 jobs, that's a net number, okay? If you look under the surface, you'll find that there were 6.5 million people hired, but there's 6.2 million people separated from their job, and we know from the quits rate there's about 3.8 million that are quitting. So the rest are kind of retiring or being fired, and these people are being hired. There is significant churn under the surface. What we see is just a net number going on. The mix churns a lot. So if you relied on AHE January, February, March, it gave you the wrong impression. ECI says here's a job. Next month, the same job, what does it pay? The next month, the same job, what does it pay? As opposed to looking at a company and saying, well, what is your average, what's your payroll? How many people do you have on? And we'll figure out your average hourly payment that you make, or for the individual, what their average hourly earnings happen to be. You could have a company that doesn't change employment very much, but decides to lay off 15 engineers and hire 15 frontline workers. Well, you've had a big change in the mix with no change in jobs, right? So it's the churn under the surface. There's a lot of churn under the surface, and the number that's reported is net. It's not as if, all month 339,000 people got a job. No, usually it's like 6-7 million people got a job, but 6-7 million people walked away from a job. So it is actually quite significant. Can someone explain what someone means when they say they're overweight, underweight, neutral in telecom stocks? Okay, so you have the S&P, the SPX, and it has 500 stocks, and GM represents 0.6% of the index. But you decide that you're going to benchmark the SPX. You're going to own the same things as the SPX, but instead of owning only 0.6, you're going to bring it to 0.8. You are overweight. Based on what the index is holding, you're holding more of a particular stock than the index is holding, hence you are overweight that stock. Now, if you only held 0.4, you would be underweight. When you're overweight, you're saying the SPX is going to go up, let's say 12%, but I think that GM will go up by more than 12%, so I'm going to be overweight. So you want to be overweight the components you think will outperform the index. You want to be underweight the components you think will underperform the index, and by doing that, you hope to beat your benchmark. And we say that you have a benchmark if you invest according to that benchmark. But if you're investing all over the place, well, then it's not really your benchmark. And if you don't have a benchmark, the terms overweight and underweight mean nothing. They're useless. Overweight and underweight mean something in terms of what you would buy versus the benchmark itself. Overweight is another name for buy. If you are benchmark aware, you overweight a stock. If you have no benchmark, you buy the stock. There's the difference there. At what price would you feel AI hype is fully priced into S&P? It's never fully priced until it breaks. It's never fully priced. When is it going to be full? It's been fully priced. It is overpriced and will continue to overprice. At what price point would you go max short beta again? I wouldn't. You don't short momentum. You don't short momentum. Do you mind explaining the result of the Fed model? 10-year yield minus the dividend yield. 10-year yield minus the index earning yield. The dividend yield? I don't think it's a dividend yield. I think it's the earnings yield. 218. On May 4th, this number was 184. just theoretically speaking, because 10 years is higher than the earnings yield. 10-year, okay, well, you're using the dividend yield here, though, not the earnings yield. This is considered bearish. Not a good time to get into equities. If you use that model to find a fair price on the S&P, it ends up being this ridiculous price. So I don't know that there's a lot of value in there. I think there's more value in looking at a 6-month Treasury versus an earnings yield, because you can get that for 6 months. Over 10 years, there's a lot that can happen. That's a full cycle on the S&P. I don't know that I would sit in a 10-year Treasury for 10 years just because it has a higher yield than an earnings yield, or because the premium, the equity risk premium between the two is too small. For 10 years, I don't know that I would do that. But 6 months, maybe. I see you planning to be long put on DHI, community sold to REITs. It could be value of capital to invest in new housing at an affordable price. Well, first of all, they're not going to invest in new housing at affordable prices. They're going to get the highest margin they possibly can. Have you also planned a long call to neutralize? Why would I neutralize? Nope. Neutralize. That would add to my position. If I'm short a put, I got positive delta. If I'm long a call, I have positive delta. It's actually adding to my position, not neutralizing. And no, I would not sell a call. Picking up points of carry, I already explained that. Wheat trade, I googled wheat futures for April 2019. I see a much lower price. You can check trading economics as well. Has IBKR made any adjustments to the price, or am I seeing the wrong wheat futures graph? I don't know. April 2019. Beats me. I don't know. I'm not quite sure what the question here is. We're going back to April 2019. Yeah, I don't know what it is that you're asking me on that. Why do you think that below 600 is a low risk place to be? How did you come up with 600 and not 500, for example? Well, just look at the chart. Just pull the chart up and have a look at it. It's lower prices are lower risk. Yeah, I'm not sure exactly what it is you're asking me here, because I can't get my head around why you're looking at April 2019 when we're in 2023. Make adjustments to the price. Yeah, so I would say yes, you are looking at the wrong thing, because this is from 4 years ago. So I don't know how to answer you on that. Do you still think it is inevitable Tesla lows at 355 in SPY? If NVIDIA never happened, yeah, I think it is inevitable. But with NVIDIA happening and now AI is all the talk of the town, I don't know. My conviction drops every time I hear the words AI. I started with a short call at negative 0.3 delta. Market rallied, so the call became -6. I added a short put at 0.3 to get back to -3. Okay. Market rallied even more, so I increased the short put to 0.5. Call as a delta 0.8. Yeah, okay, that's fine. You're still at 0.3. I see the daily P&L, and the call is more expensive to the underlying price. The call is more sensitive to the underlying. Well, of course it is. It has a 0.8 delta. But you've always maintained the 0.3. What you've done is you've kept rebalancing back to 0.3. I never once said that will make you money. I said that is risk management. You were comfortable with 0.3 delta, taking on a risk of negative 0.3 delta, and you kept rebalancing to negative 0.3 delta. That doesn't mean you're going to win. It just means that if you do lose, you will lose less than if you did not rebalance your risk to 0.3. You're minimizing the downside by rebalancing your risk. It doesn't mean you're making money. But yes, the call is more sensitive because it has a delta of 0.8 at this point. Can you explain what the risks are in levering up T-bills? IBKR requires 1% of notional in margin, and margin costs 6.5% on interactive brokers now. So you'll pay 6.5%, 6.5% to get 5% return. There's your risk. Is you're using a short-term borrowing rate to lever up a short-term lending rate, and the borrowing rate is above the lending rate. There is no carry trade at the short end of the curve in that sense. So you know, it'll just cost you money. Will the AI hype hold up in a recession? Well, I don't know. We'll see. Could AI hype avoid a recession? Well, if enough companies believe it and start hiring people and ordering product and getting this done and putting this into place, and you know, it's not going to eliminate employees right away. It could create more wage inflation, you know. But no, I don't know the answer of would it hold up in a recession. It could. Have a theta target of 0.05% of portfolio, no positions in underlying now. I struggle to beat the market. Well, that is the problem with having a single strategy portfolio. An income factory is one strategy to have, and it is difficult to beat the market when the market is moving up by having a single strategy. It is just a strategy. It is not the strategy. It is one tool that you would use as you say, okay, well, some of my portfolio will be for income, some will be directional trades, some may be volatility trades, some will be uncorrelated trades, but you're diversified across strategies. That's why we set the theta target that low, not because it represents everything you should be doing, but because it represents a small enough portion of your portfolio that it doesn't get in the way of the other things you should be doing. But it is one strategy to use that generates basis points of returns. Then you have another strategy that generates basis points of returns, and another one. But diversification across strategies, this is just one. How much percent of my return should come from pure theta decay? I guess you're familiar with Tasty, Tom Sosnoff, where they have zero beta delta. You find this okay? Well, they're just getting no direction, and when you have no beta or no delta exposure, you can use a higher amount of your portfolio for that strategy. Unless the market moves completely against you, then the calls, if the market drops, those calls will not save your puts. You will get hurt. That is a sideways or a trending market strategy, but not a high volatility market, and especially not a strategy that goes from low vol to high vol. That would not work at all. Target 20% return per year from all theta decay. 20% return on the capital you employ, but not 20% return on your portfolio. You really got to bring in other strategies as well. I feel I should allocate some to just hold positions, but difficult to do these at these PE ratios. That is true. Trying to roll the 4,000 MES call June 16th, but there is no bid-ask spread. Oh, calls? Yeah, that far out of the money? Probably not. But it's okay. Just let them be assigned to you and then roll them. If you let them be assigned, you'll have the MES contracts. You can close them and then open up new ones. Yeah, I wouldn't worry about trying to close them if there's no bid-ask spread. How can a new position be uncorrelated yet have a beta effect on the portfolio? Well, then it wouldn't be uncorrelated, right? Specifically, how do you quantify the DDB effect of, say, wheat on the total SPX equivalent DDB of your current book? There's no beta. There's no beta. In fact, it doesn't even show up in the DDB calculation. It is a separate tab altogether. There is no beta to it. So I'm not really sure where you're getting the beta effect on the portfolio. Unless you're seeing something I'm not. I don't see a beta effect. What news sources do you usually read? I don't have a preference. It comes from all sorts of places, and you know, with Apple News, with IBKR giving me a news stream, with you know, all the different news streams that you get now. Stories just come your way from a whole bunch of different sources. Do you have any ideas for financing option premiums? Say I want to buy calls to speculate on AI, but I want to make sure I finance with short puts. But the vols are quite different, and I don't know a good methodology to do some form of risk neutrality. One idea was to use the delta of each leg with beta. Oh, to be dollar delta beta neutral. I'm not quite seeing what you're trying to do. If I'm trying to buy something, I don't necessarily have to figure out how I'm going to finance it on day one. I can just buy it, because here's what's going to happen. And it's easier to step into positions rather than do them all at once. Let's say I buy a call and the market goes up. Well, I'm winning right away. And the market goes down instead. Well, then I can sell a put much deeper or much lower in price than I could have had I put it on at the time of the call. Right? So I want to buy a call, I buy a call. My financing decision of that will depend on what the market does. If the market goes up, well, then maybe I sell a call above it. If the market goes down, I can sell a put a little bit deeper down than I could have on day one. So buy the call, then let the market tell you how to finance it, as opposed to you figuring it out on day one. And lastly, do you know if there's a way to get the DDB figure column in IB? Yeah, click on the settings and just add it. Ken Griffin from Citadel said in March that U.S. capitalism was breaking down before our eyes with SVB. Okay. Does the debt ceiling deal effectively kill the potential for U.S. fiscal stimulus through next election if a recession were to occur? Well, any new stimulus, yeah. I could see this being quite a deep recession if, in fact, the current capitalism market is driven from government spending and no fiscal stimulus were to occur in the event of a recession. Well, there is one conspiracy angle that you can take, is that there is no new spending except under the condition of war. That if the U.S. declares war, they can do spending. So things are going bad, the economy sucks, let's declare war on China. I don't know. I mean, you could do that if you need to get out of it, but the central bank lowering rates to zero, I think, would be enough. Read an article in Wall Street Journal labeled "Business is Slowing, so companies are juicing profits," which mentioned the M-score as an indicator of potential financial statement manipulation. Yes, and I did bring this up before about earnings quality, that the quality of the earnings that we're seeing has been deteriorating. I mean, you can just look at the tech companies, all of them, and I've mentioned this before, and this is the oddest thing in the world, is when you look at Google, you look at Microsoft, you look at Amazon, you look at Facebook over the last year, all of them have used this for depreciation as saying, it's not 4 years, it's 6 years. And most of them have added anywhere from $750 million to $1 billion to their bottom line by doing this. But if you look at their cash flow from operations, they all have dropped. And if you look at cash flow from investing, they're all investing significantly less. Microsoft, negative $13 billion. Google, negative $3 billion. I think only Facebook actually increased its investment. Yet you hear NVIDIA talking about demand being off the charts and everyone's buying these chips and we're raising our guidance and we're doing this. And it's like, well, hang on a second. If this actually takes more computing power, how are these servers now lasting 6 years and not 4 years? And if everyone's buying these chips, how come everybody's cash flow from investing is significantly lower than it was last year? None of this makes any sense. This story does not mesh very well at all. So yeah, if you want to talk about earnings quality has been deteriorating. What's your take on this ratio, and have you used it in the past? No, the M-score is something that you see in level 2 FRA, but I've never used it. Interesting, they also mentioned Google have been boosting profits by increasing the useful life of their server. Yes. Tech companies have been doing this for the last couple of years, have been boosting their profits by increasing the life of the servers in an era where AI is supposed to take more computing power. Suddenly these servers that are going to last longer than they thought, but NVIDIA says everybody needs this stuff and we're raising our guidance, but no one seems to be spending. So You know, big freaking question mark on all of that. I can't square that. So if somebody knows something that I don't know, tell me. How much of an impact do you think the resuming of federal student debt payments will have on consumer spending? Well, it'll have an impact. I don't know how much, but it'll have an impact. Now, keep in mind that while there has been a moratorium on students having to repay their debt, that does not mean students are restricted from paying their debt. Many of them have been paying their debt because they said, what's the point? I mean, the moratorium is great because the interest, I'll save the interest, but I should pare this down as fast as I can. So many of them still have been paying down their debt, but they don't have to. That's all that's saying, is they don't have to. But many of them still have been paying down their debt. So I don't know that it's going to be as big a deal as it's made out to be. But at the margin, it's less money that's going to go towards consumption, right? According to Wall Street Journal, a little more than 1% of borrowers continue to make payments. A little more than 1% continued? I don't know. I don't know if that's true. I find it hard to imagine this won't ripple through other areas of the C portion of GDP. The thing is, if you're looking at outstanding student debt and you saw it kind of dropping, and you said, well, it's only dropped enough that I can imply that 1% has paid it off. That is missing the point that some students are paying off their debt while others are adding. Some are paying off while others are adding. You got to look under the surface for churn, not at the level of the surface. Calm waters can sometimes belie the storm going on underneath, right? So I don't know what the rigor was in getting to the 1%. Margin required in IBM. Okay, I already answered that. Keen to get your take on what was said. Let's see. No, this was this morning. A large company can fund at 3.6% plus a spread. That would be around the 10-year yield plus a spread, and invest in T-bills. Yeah, they can. They can. Same with homeowners. 98% of homeowners have a mortgage issued at lower rates, according to Goldman. Alberto says Fed doing half of their job by tightening only the front end of the curve. I think they're only doing 20% of their job, really. I think it's much lower than half the job. I think a significant part of the economy is immune from interest rates. Thinks long end funding costs also need to go up in order to tighten financial conditions. Well, if companies are just doing this, borrowing money and investing in T-bills, if that's what they're doing, that's not inflationary at all. So it's not as if the Fed has to shut that down, because it's not actually getting into the real economy. That's just the financial economy, and that's not inflationary. It may be holding up prices of things, but it's not inflationary in that sense. Steepening the long end of the curve isn't going to do anything to those homeowners who have fixed rate mortgage. It isn't going to do anything to these companies that have debt in place with interest rate swaps. It'll only affect the marginal borrower, not the current borrowers. It'll only affect the marginal borrower. That's with the balance sheet runoff is kind of doing that right now. But when we think about a yield curve, right now it kind of looks like this, right? And here's your money market rates, here's your capital market rates. Your money market rates tend to reflect where the Fed target rate happens to be. And people who, this would affect any floating rate debt. Because as money market rates go up, the interest rate on floating rate debt goes up, but the income you get on floating rate securities goes up as well. And if you have an interest rate swap in place, you're good. A lot of debt is fixed, and fixed at rates that are not dependent upon the shape of the yield curve today. This really reflects prospects for GDP growth and expected inflation. So the more inverted this curve goes, could be that we're expecting lower real GDP growth or lower inflation expectations going forward. If you want this curve to raise, you have to then encourage everyone to think that you're going to get much higher growth and much higher inflation. You see the problem? So it probably wouldn't do it on its own. I've never heard these comments before. I listen to surveillance every day. Well, Alberto's correct in the fact that the Fed interest rate hikes, when we talk about interest rates, this is what we're talking about. When we're talking about bond yields, this is what we're talking about, right? Interest rates are short-term rates. These are not interest rates over here. These are interest rates over here. So interest rates going up isn't finding its way into the economy is a true statement. The longer end of the curve going up, yeah, you could take away that reverse carry. Well, I wouldn't call it a reverse carry trade, but the carry trade of borrowing long and lending short. But are corporations doing that? Are they floating out long-term bond issues just to make a carry trade on the short end of the curve? Are they committing to a higher borrowing rate for the next 10 years, the 3.6 plus a spread? They're sitting around 5.45 to 5.5%. Do they want to commit to that for 10 years, knowing that that they're only going to earn carry on the front end for maybe 3 quarters or 4 quarters? I don't think so. So I don't think corporations are engaging in that type of carry trade. But I do agree that the interest rate hikes are not being felt in the economy to the extent that they think they are. The market has been using undiscounted forward PE as a valuation tool for decades. As trailing PE is backwards looking, I don't disagree with your view to discount the earnings, but why wouldn't any... oh, that's not what I was saying. I wasn't saying you discount the earnings. Not at all. What I was saying is that if you're going to use 2024 earnings, you have to. Let's do a timeline. Let's say we're right here. Forward earnings. We know it as of this date. We know the price of the SPX as of this date. You can calculate a forward PE. You can calculate a forward PE. However, you say, well, let's just ignore this 2024. Here are the earnings. So if you take these earnings and compare it with this price, it's only at 17 times earnings. My answer to that is, whoa. You're comparing money at 2 different points on the timeline. This here is the forward earnings as of this date. This is the price as of this date. You must discount these to compare it to this, or you must bring this forward and you must compare this with the forward price of SPX. So in other words, if you're going to use 2024 earnings, you have to use a forward price for the index. You can't just say, here's the price today, and if we look out in the future, here are the forward earnings, and then compare the two. These are at 2 different points in the timeline. You have to discount those. But as of this day, you say, this is our estimate of forward earnings, this is our price, this is at the same point in time. You can calculate a forward PE. But this is, a crime, a time value of money crime by saying, I'm going to take a sum of money that is an estimate for a year from now, and I can compare it with a sum of money for today. Can't be done. You must account for the time value of money, so you got to discount that first of all. So, I don't agree with that. If we think about, well, okay, it's 17 times. Well, then you need to carry that forward, and if that's 1 year, multiply 17 by 1.05, you get 17.85. That's a little bit more logical, right? And the second thing I don't agree with is what we're doing when we forecast earnings is they're forecasted linearly like this. And as we adjust earnings, if we adjust them down, then the whole line shifts down or the whole line shifts up. Well, you're forecasting these earnings from this trajectory point. I have so many problems with the idea that we're just going to skip ahead. If you're going to skip ahead, why stop at 1 year? Why not go out 50 years and say earnings are going to be $1,000? SPX is only 4,300 now, so it's only trading at 4.3 times the forward 50-year earnings. That's a deal. Look how ridiculously cheap the market is. Right? I mean, why stop at 1 year? Why not go forward and you can make the market as cheap as you want it to be by committing all sorts of time value of money crimes. It's a crime. That's all I was pointing out. To use 2024 earnings with today's price without realizing that you're comparing numbers at two different points on the timeline. They do not have a CFA. They did not take derivatives from me, because they would never have made that mistake. Problem may not be capitalism. Maybe the problem is the constant human need to intervene and try to moderate things when they could just self-correct. It could be. It could be. When we make a video about 2024 changes, already have on my channel. Hi Mark, please see ChatGPT summary of your auto-generated YouTube transcript. That's not a question, so we'll skip that. What about sugar? I don't really follow sugar. For healthcare sector enthusiasts. Okay, so this is just not a question. That's for somebody else. Would a Trump victory imply a rate cut to 0? Well, I think he would. I don't know that I think he'd scream at Powell. Yeah, probably. But I don't know that it would imply a rate cut to 0. But I think he'd either fire Powell or call Powell names. Case Schiller went up with rising rates in 04-06 also. There's a big difference between demand-induced and supply-induced inflation here, right? 04-06 was demand-induced inflation. So demand was strong while rates were going up. Here we have supply constraints. So you have housing prices right now are more a function of a lack of supply than an excess of demand. Because if you look at pending home sales, they are down year over year considerably. That means we are selling fewer homes this year than last year, but pretty much for the same price because of the supply being low. I'm not buying the low supply. You're not buying the low supply BS? Oh, well, you're you. I said the same thing last time. Housing starts down since 2021. Looks like we are in the 2006 phase of this thing. I don't think so. None of the numbers say that we are anywhere near the number of housing starts we were in 2006. Nowhere near the housing starts in 2006. There was massive supply coming on the market in 2006 in terms of new home construction on an annualized basis that we are nowhere. I think we're 50%, even 40% of that level now. No, not at all. In 3938, you said that if profits are produced primarily from the taxpayer spending. No, I didn't say they were produced from taxpayer spending. I said that profits, if my capital gain in the market is primarily dependent upon fiscal and monetary stimulus, then my capital gain is being delivered to me by government institutions. Not by capitalism itself, but by government institutions. And if I am reliant on the central bank and the government to continually prop up markets to deliver me my capital gains, then tax rates are too low. The tax rate on capital is far too low if we conclude that the only way we can stay up is with continual government support and government intervention, whether it be fiscal stimulus, whether it be monetary stimulus. But if that is the position we're in, where we continually have to rely on that, then tax rates are too low, because it is government that is delivering those capital gains. So I didn't say they were coming from the taxpayer. So it's just if I'm getting a capital gain that is primarily delivered to me by either the central bank or fiscal stimulus, and my capital gains is taxed at 50% of my normal tax rate, but I'm reliant upon the government to give me that gain, primarily reliant on government or government institutions to give me that gain, then why should I have a special tax rate on something that government or government institutions supply me? That if they did not do anything, I wouldn't have made that gain, right? So, yeah, I think tax rates are too low if most of my if I have to rely on government stimulus and monetary policy for my capital gains. And that's it. We're done.